From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny. We're going to count you down to the open. It's the slowest jobs growth in 6 months and a double-digit drop in twos. We're repricing the rate cut narrative. Countdown to the open kicks in right now. Coming up, it was a downside surprise in the U.S. payrolls report, sending futures higher and Treasury yields lower. Apple announces the biggest buyback in U.S. history. We begin with the big issue, the jobs data in the USA. Let's get straight to Mike McKee to break these numbers down. It was a bit of a shocker on the downside surprise, and wages were lighter on their feet. Mike, good morning.
Good morning, Manus, and it's a good morning at 20th and C Street in Washington, where the Fed has to be happy about these numbers. Obviously, Wall Street is. 175,000, as you mentioned, the lowest in 6 months, and it's a big drop from 313,000, a revised 313 last month. Last month does seem to be an outlier. We also saw the unemployment rate rise a tick to 3.9%, but that's basically pushing it out to three digits. 0.02 of a percentage point made the difference here, as it was rounded up to 3.9. Average hourly earnings also a pleasant surprise. They come in lower than anticipated, 0.2% higher, pushes the year-over-year number down to 3.9%. The job breakdown is basically what it has been for months, with a few changes. Healthcare and social assistance, always the big gainer, 87,000 jobs. Retail, 20,100. Americans still spending and retailers still hiring. Transportation and warehousing, this has been a category that's been losing jobs, and now it's up 21,800. The biggest loser, administration and support. And we've seen in the layoff announcements that we've gotten recently that it's been these mid-level people who have been getting the axe at the corporations who are cutting back a little bit. The Fed is, as I said, going to be pleased with this. The markets are going to be pleased with this. You look at what has happened over the last year, and you can see the blue line is the 2-year note. The white line is the Fed target. Fed hasn't done anything, but these numbers push the markets around. Just doesn't know what it's going to do, but it looks like its bet on holding steady is going to pay off.
Okay, Mike, thank you very much. Great roundup on the data. How does it transfer to markets? This is about repricing. Repricing from virtually no cuts to a rate cut now in September. Double-digit drop in terms of yields across the board. This is the 2 years, down by 11 basis points. It sparks a renaissance across assets, with equities flying higher. Yes, the job growth might be slower, the wage growth might be slower, and therefore the long variable lag may well be coming to effect in terms of the real economy. We've gone from 7 rate cuts to 0 rate cuts, and we're now potentially pricing up to 2. There's a sigh of relief in the Bank of Japan as that currency has rallied by 3%. Rieder is with me with a special guest from D.C.
Thank you, Manus. We welcome now to our TV audience and radio listeners. I'm Rieder. Joining us is Acting U.S. Labor Secretary Julie Su. Acting Labor Secretary Su, thank you so much for your time this morning. We've heard from the reports. The Fed would seem to be happy with this kind of jobs report. The market is certainly happy. It's this Goldilocks, potentially softening to have a landing of this economy, to a soft landing. What we're seeing right now with this softer report, and the market's certainly taking it in stride. Is that the consensus as well in the read from the Biden administration?
Yes, that's exactly right. This is another strong jobs report, and these numbers just keep showing us month after month that President Biden's economic strategy is working. It's everything you said. It continues to be strong, stable growth, sustainable growth as well. The unemployment rate is still under 4%. That's the 27-month straight that is the case. And the prime age labor force participation rate remains strong. It ticked up a little bit. And for women, it's the highest it has been since this number's been recorded, which was begun in 1948. So this is a strong jobs report that continues to be indicative of a very strong economy.
Well, this is what we heard from Chair Powell earlier this week. Quote, strong job creation over the past year has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and the continued strong pace of immigration. How much do you see immigration playing into the supply side of this labor market?
It's all part of the story. Immigrant workers have, throughout our nation's history, helped to power our economic strength. At the same time, what these numbers show is that the jobs for native-born workers remains very, very strong as well. So when you have such sustained job growth, there is really, it's beneficial for everybody.
Well, we do have a lot of immigration. The CBO, of course, looks at 2023 when they thought maybe it was going to be 1 million. Immigration actually at 3.3 million. But how do you match that supply to demand, especially if these are a lot of undocumented workers? How do we match the supply of potentially, are they going to the right jobs and the demand the U.S. labor market actually needs?
I mean, this is something that the Department of Labor is laser focused on every day, is making sure that we are connecting people to the good jobs that they want and need, especially in this moment of such historic job growth, not happening just by accident. It's happening because of the resilience of the American people, because of the small business boom that we're seeing, because of working people. You know, the president says all the time, it's the middle class that built America. Unions built the middle class because of strong growth for unions. And it's also happening because we are seeing people coming into the labor market. And so this is a moment where we have to be able to connect people to those jobs and employers to the people that they need. And that's why our workforce development system is so important, and why when I travel the country and I see training programs that are bursting at the seams, it's another indication that this economy is moving in the right direction and that Bidenomics is having a positive effect in communities all across America.
The survey response rate, though, for this report was 54.9%, the lowest, Julie, since 2002. How accurate, then, are these numbers?
Well, the Bureau of Labor Statistics remains the gold standard for reporting on unemployment, on job growth, on different industries. It is the largest body of data that exists. And let me just say, the numbers tell part of the story. I mean, the numbers remain reliable. They remain, what is relied upon to evaluate our policies and also to look at what new policies we should be pursuing. But the numbers are part of the story. The other is that the president promised that he would build an economy from the bottom up and the middle out. And in the last so under his leadership, we have restored the 40-hour work week for millions of Americans. We are making sure that retirement security is something that all American people can enjoy. We are looking out for workers who've been left behind in the past. I've been in Uniontown, Pennsylvania, talking to mine workers who've had to be exposed to silica dust. I've met with farm workers in California who put food on our tables, but have to die in vehicles that are cramped without seatbelts. We are also addressing those issues. And so the overall numbers, again, are part of a story in which President Biden is delivering on his promise to build a strong economy in which everybody can play a part in it and see themselves having a secure future.
But back to this survey, that would put the standard error at 130,000. So it could be 305,000 or 45,000. Anywhere in that range is statistically accurate. How concerning is that, given this data is highly important, not just to the Fed, but also to the president?
No, that's right. I mean, the numbers are reliable. We continue to work on survey response. The people sometimes think, well, the numbers get adjusted each month. What is that about? That's also very much part of what we do. It's it's part and parcel of making the numbers as accurate as possible. So sometimes numbers come in later, and that's why we make adjustments. And again, this is the gold standard for a reason, and we do want to continue to increase the response rate that we get.
I just want to end on the fact that wage gains are less than what was expected. And when we continuously poll the American electorate, they're not worried about jobs so much in the sense that they're actually worried about inflation. And if the wages are not keeping up with inflation, how concerning is that to you?
So wage gains continue to outpace inflation. That means that there's more money in workers' pockets. This is obviously, as you say, this is a sign of how good people feel. And a good job changes lives, and a good jobs with wages that are enough to sustain a family are really important. And we continue to combat inflation and high prices. That's why the president's so focused on combating junk fees, on making sure that prescription drugs are affordable, and so it's a whole holistic approach to investing in the American people, and we are on the right track and will continue with the work.
Julie Su, thank you so much for your time this morning. Acting U.S. Labor Secretary, of course, Julie Su. Manus?
Anne-Marie, thank you very much. Great conversation there in terms of the rounding errors, as Anne-Marie just pointed out. The potential is for something up in the 300s through to 45, but a spirited defence by the acting secretary there. Coming up on the show, more on the labour market, the signs of a cooling.
We've had 27th straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No, but if the increase accelerates, that would really worry me.
Okay, BlackRock's Rieder joins me next to dig into the data.
We've had 27th straight months of the unemployment rate below 4.4%. We haven't seen that since the 60s. So we have been an exceptional economy. And does it surprise me? No, but if the increase accelerates, that would really worry me. Remember, especially at the low income side, wage are key to consumption and key to economic growth. Pandemic savings have been run down, credit card balances have been run up, so wage income is absolutely critical to the well-being of this economy.
Those are the concerns of Mohamed El-Arian in terms of an acceleration in the unemployment rate. My guest this morning is Rieder, BlackRock Chief Investment Officer of Global Fixed Income. You should be sitting with a smile on your face, and you are. The bond market is like the hounds have been unleashed. Double-digit drop in yields. The bond market believes not only are rate cuts coming, Rick, on this softer jobs number, but they're coming earlier and potentially in more size. Are you joining the smile? Good morning.
Thanks for having me, Manus. So listen, I think that it's amazing how markets, they came in the beginning of this year expecting 6-7 cuts. Then it's like no cuts. And it's amazing how people revise their forecasts. I mean, now we're pricing in 2 cuts for the year. I think that's about right. And listen, we still have to see the inflation numbers come down. But I'm pretty blown away by this number in a couple of regards. The symmetry, by the way, the 3-month moving average of job hires, 242,000. The 6 months, 242,000. And if you actually add up the last 2 months, they come up to 245,000. So it's pretty unbelievable. The economy is stable, but at the margin, and I think this is what's the big deal for the Fed. It is starting and hiring is starting to decelerate. And that is a good thing. So listen, I think I've not said this a bunch. I think the Fed would like to get a cut or 2 in this year. And today opened the door for them to get that done. And but you still have to see some better inflation prints over the next several months. So we're going to be pretty focused on that.
Yeah, I mean, everybody's berated the 3 hot inflation prints and telling us, it's not enough to establish a full trend. Here we are, one day, one slightly lower reading on jobs, and we are quite literally off to the races. So let's dig a little bit deeper. You talk about the overall trend. Again, do you think that Powell, obviously, they said that he potentially had access to this data. He pushed back against the concept of a hike, and he sounded particularly dovish, and he was convinced that we were in restrictive territory. Do you think this is the beginning of understanding what the incremental impact of restrictive rates is?
So, yes. I mean, I would say a couple of things to that. One, I think the chair was very clear about the bar for hiking rates was extremely high. And I think that was a big deal for the markets. I think he basically took off the table that they're considering that anytime soon. And that you should just sit back and wait and see, and the data will start to move in a direction that allows them to start the cuts. I think that's a big deal for markets. Listen, and particularly in fixed income, people are sitting on immense amounts of cash. You see this in money market funds, you see it in deposits. And boy, anything that for the markets gives you some sense, okay, they're not considering rate hikes anytime soon. I can feel a little bit better about putting money to work, and the income levels you can generate are substantial today. So, your comment earlier about unleashing the hounds. I don't know about the hounds, but I think there are a lot of people who are saying, I just don't want to get bludgeoned by rate moving higher. And listen, I think when you look at some of these numbers, healthcare in today's number was healthcare and education 95,000, 175,000. So if you strip out healthcare and education, not cyclical, not interest rate sensitive to any significant measure, we're talking about an economy that is slowing a bit and allows the Fed to move. And then this gets people comfortable that, gosh, I can put some money to work, particularly at these yields that we haven't seen in a couple of decades.
Well, we haven't. Let's just talk about the yield moves today and this week. Two's down 11 basis points, give or take a tick. I need to refresh my price. Down 23 basis points on the week. 10's down 10, down 19 basis points on the week. Have you been actively deploying? Would you be an advocate of active deployment into this market this week? I mean, the ECI was just a couple of days ago, and we were freaking out with that. So just contextualize those kind of moves for me this week and today.
So I think there's something pretty spectacular in markets today in fixed income that is worth sitting back and taking note of. If you're holding income today let's say in the front to the belly of the yield curve, and then we talked about it last time on the show and the time before that, the yield is so let's say that rates stay here. Let's say rates move up a bit. If you can carry, in my ETF, we're carrying almost 7% yield. And you think about what that means. Every single month, I'm throwing off 55, 60 basis points of carry. So let's say rates move up a bit more. Gosh, it'd take you a month to work through that in terms of because your income level is so high. So if you said to me, have we been doing things? Yes. Do I like owning these yields in this front bill? And do I like owning income, investment grade credit, some mortgages, some securitized assets, high quality assets? You could throw in a bit of high yield. Boy, this is, I've been doing this a long time, like for a decade or longer than that. You're saying like, I gotta own some risky assets because yields are close to zero. Today, you could feel pretty comfortable because your income and your carry is so substantial of holding some of these assets, and your return will be pretty hard unless you think rates are going much higher, which is almost inconceivable given the moderate deceleration in the economy. Then you feel pretty good about owning that part of the yield curve. Longer in interest rates. Tougher story. Do you need it with a curve this flat? I don't think you really need a lot of long interest rate exposure.
Look, the market has decided to put its stake down in the ground today. It's turned the page on higher for, I would say that the market has decided to turn the page on higher for longer and to reflect. Perhaps not just as high for not just as long. Is it too early to do that?
So, listen, I think you have to assume there's an extraordinary amount we're in this era of infrastructure spend, climate spend, AI spend, the energy that has to go in around it. There's a lot of capital that's got to come in simultaneously or be put to work to support this sort of CapEx and R&D spend in the economy. Secondly, you have a dynamic where if you look at these payroll numbers and you go back a ways and think about, why are wages this elevated? There's actually not enough people without immigration. Certainly, there's not enough people for the roles that are out there. So I think you have to assume that we're going to be at a higher, and by the way, the Treasury's got to issue an awful lot of debt.
Yeah.
So you've got to assume we're at a higher interest rate threshold than you've been at historically. But, it's also why you're seeing a lot of asset allocation. Every day I see this. People say, I own equities. By the way, I still think equities make sense. I own equities, but boy, I can create a bit more balance in my portfolio, clipping some income. And these yields are pretty attractive. If you think endowments, foundations, pensions, they have a return target in and around 7%. You had to get it through equities. You had to get it through alternatives. Today, boy, you can get it through some fixed income assets with not a lot of volatility, not a lot of beta to them. That's a pretty unique point in time.
I came across a lovely phrase from Bank of America this morning, so bear with me on this because I quite like it. Crashes in cocoa, corrections in crypto, and wobbles in gold. And the thesis is those bubbly assets of 2024 showing signs of a higher for longer stance is now percolating through the market. But you extrapolate that a little bit further. You talk about non-mortgage interest rate payments. So put your thesis to bubblicious. Bubblicious could be blowing up according to Bank of America. You've got a slightly more intellectual take.
Oh, I don't know about that. But I would say, listen, I've done a bunch of presentations recently to show what's happening when you keep the interest rate this high, you're actually putting a lot of pressure on lower income. You're putting a lot of pressure on local banks. You're putting a lot of pressure on commercial real estate, small business. You have an economy that's very disparate today. You've got part of the economy that is a borrower. That is really getting hurt. And you're seeing that when you look at the earnings reports, you look at the dispersion in some of the lower income, some of the small business versus some of the big business companies that don't have to fund themselves. Look at big cap tech that funds through free cash flow, buying back huge amounts of stock. Not that not at all really interest rate sensitive. So you have what is a two-part economy. And, you're witnessing part of why I think the Fed needs to bring that rate down over the next, certainly the next few months is, gosh, it is pressuring. And I think where Chair Powell is right in a lot of ways is there is some real restrictive behavior here, but it's impacting a part of the economy, and the pressure there has become pretty acute, and you're starting to see that in the numbers.
Do you think in 30 seconds, they must be mopping their brows and raising a glass of sake in Japan tonight?
Listen, Japan is a really interesting. I mean, the yen move this week is keeping me up during the night, to say the least. There is, it impacts rates markets. By the way, Japanese equity stories have been a pretty good story here, and how the central bank moves the currency is going to be interesting relative to that. But yes, stabilizing a currency that had a shocked move earlier in the week through 160 was has to feel a bit better. Obviously, a lot of intervention to get there, though. It'll be interesting how their policy evolves away from intervention, given what we saw last week or so.
Rick, thank you very much. Compressed and to the point. Thank you for joining me on Jobs Day. Rick Rieder there. Morning calls a little bit later. We got PGIM's Michael Collins joining me around the opening bell to discuss the outlook for markets after this softer number on Bloomberg. You gotta love payrolls Friday. In theory, it's all going so well. Yields are down, double-digit drops on 2s and 10s. Apple is resplendent. Monster buyback, $110 billion, the biggest in history. The stock is up 7%. And they decry those China bears on their numbers. Look at this. Stocks are up over 1% on the SPOOs. But taking it away, it is tech as those yields drop. Tech is resplendent. NASDAQ up 1.5%. I can sing you the Goldilocks tune if you'd like to. But in the meantime, I will give you your calls. Bernstein downgrades Peloton to market perform. Moving to the sidelines on lingering growth and debt concerns. Morgan Stanley downgrades Estee Lauder to equal weight, expecting a muted sales recovery due to numerous macro headwinds. And finally, JP Morgan raises Apple to $225. We are pro-risk at the moment as yields drop. There's 175,000 of jobs growth. That's significantly less than the market had anticipated. Wages are tempered. And so the narrative changes about the timing and potential and the size of rate cuts. Equities are bid. Apple is up. Let me take you through the rest of the assets, because the bid in equities in some and in many ways is inextricably linked to the drop in yield. You're looking at double-digit yield drops from 2s, and we've just come back a little bit in 10s, but I can assure you that on the week you're looking at 2-year yields down by 23 basis points. 10s are down by 19 basis points. Rick Rieder was just with me there, which is, get on board here. The market has moved now. The long variable lag seems to be just snapping ever so slightly at this. 3-month unemployment, 242,000, or jobs created 242,000. They're breathing a sigh of relief in Japan. That is the dollar down and the yen up, strengthening by over 3% this week. So you are just looking at a strengthening in the yen as they unilaterally intervene, and many say it will not work unless you get G2 intervention. I mentioned Apple. Now, look, the tech giant has announced the biggest stock buyback in U.S. history of $110 billion and an upbeat forecast. Ed Ludlow is with me. So there's something of a misnomer here, Ed, isn't there? There's the Apple guidance in China versus the doomsday book scenario that we were given in the run-up to the data from Apple.
Yeah, and we are going to have to ask frequently throughout the day, like, what's the biggest driver in the stock right this moment? Is it the share buyback, the biggest in US history? Or is it the narrative about the outlook for the current period in China? The stock's up 7%, on track for its biggest jump since November of 2022. The story all told was that in the quarter gone, things were not as bad as expected, though still bad. The outlook and potentially one catalyst in the stock this morning is that in the current period, sales will grow low single digits. That's what the CFO, Luca Maestri, told Bloomberg's Emily Chang. The specificity of China is that the iPhone is doing well. That is the narrative executive painted, but they called China an incredibly competitive market where everything else is not doing as well. The AI story wasn't really there. Next week, we have the Let Loose event, which is completely virtual. And then in June, WWDC. On the BloombergTerminal.com, go and look for yourself. Mark Gurman has kind of outlined the chronology of what's going to happen. Next week will be all about the next generation of iPad, a product line that's not had a refresh in 1.5 years, but did very well in the pandemic. And if you look at the earnings call transcript, that will be a driver of growth going forward. Then in June, we'll get the AI story. What does generative AI look like in the smartphone? But a $110 billion buyback. I mean, Manus, how often have you said the word buyback or dividend in the last 3 or 4 weeks? And how important is to the psychology of investors?
OK, Ed, thank you very much. Yeah, it certainly was a fairly different story from what we thought we were going to get. And Wedbush Securities delivering their note. It's a turning point in the China story. Let's see. Turn to fintech. You've got Block revealing plans to invest a portion of their profits from Bitcoin back into assets. How's that going to work? Abigail Doolittle has the detail. Abby.
Yeah, it's an interesting mechanism. And I think that the bigger point here is that their buy now, pay later plan, that really has driven profits and revenues and should continue to do so. This, of course, after they merged Afterpay with its Cash App. They put up a 20% earnings beat. The revenues beat by 1%. Their fiscal year EBITDA also above the streets. Now, analysts really like the cost controls, the shuttering of some businesses, internal controls. Cowen saying that Block results right across the board are solid all around. Interesting, yesterday after the bell, there was an interesting shuffle with the stock to the downside. There were some reports about potential regulatory investigations regarding illicit transactions. But CEO Jack Dorsey said, no, that's not the case. And we can see this stock up about 6%. Into today, down 9% year to date, still down just a little bit, but making moves in the right direction for investors who are long Block.
OK, Abby, thank you very much. Let's turn our attention over to pharma. Amgen soaring today. The CEO saying he's very encouraged by the early results from a study of the company's experimental obesity drug. Simone, this is like magic news when it comes to this GLP area. What have they got to say?
Well, this is a drug called Maritide, and it's actually not a GLP-1. It's called an antibody drug conjugate. So one piece of it works the same way as those GLP-1 drugs like Wegovy, like Zepbound. But there's another piece, an antibody part, that apparently may stick around in your blood, in your gut, longer and may help people who are seeking to lose weight keep that weight off. So the CEO saying very encouraged by those early results, Leering increasing the probability of success of this drug to 75%. It had earlier seen 50%. In a February study, 14.5% of body weight people lost in about 12 weeks. That was the highest level. Some people keeping weight off for 150 days after stopping the drug. This has been extraordinarily positive for Amgen, seeing its biggest move right now since July 2009, and taking a toll as well on shares of Novo Nordisk and Eli Lilly. Manus.
Yeah, certainly Wegovy and Ozempic may have a bit of competition on the block. Simone, thank you very much. Simone Foxman there. Turn our attention to travel. Expedia missing its estimates, gross bookings, and cutting sales forecast for the year. Isabel Lee is with me. The detail, Isabel.
Hey, Manus, it's just a straight shoot down for Expedia. Shares are now lower by almost 12%. And it's really because of Vrbo, its vacation rental brand. Expedia was expecting a boost in profits from Vrbo because this would allow travelers to book across Expedia brands. But that migration is slower than anticipated, and this resulted in gross bookings and adjusted EPS to be lower than expected. We do have adjusted EBITDA and revenue to be higher than expected. Still, Wall Street wasn't happy with this. We have Piper Sandler downgrading the stock, saying that Expedia's booking growth is worsening and that margin uplift from tech improvements remain, quote, elusive. Price target now is set to 145 from 175. But, you know, they're not alone because Bookings, its rival, is also having trouble. It said that room night reservations is expected to slow this quarter as tensions in the Middle East continue to curb the regional tourism that they have. Expedia shares year-to-date are lower 20%, and today it's down 13%, Manus.
Okay, Isabel, thank you very much. Isabel Lee. And joining me now is Michael Collins, Executive Portfolio Advisor at PGIM Fixed Income. Michael, good to see you this morning. These bond markets, just chatting to Rick there, Rick Rieder over at JP Morgan. I was just speaking to Rick Rieder. Look, double-digit drops in yields. This bond market really, really likes what it sees in this jobs report. Can that kind of momentum sustain?
You know, I think, Manus, that rates overshot over the last few weeks. I mean, if you look at what was priced in terms of the funds rate going forward, I mean, the low terminal funds rate really for the next 10 years was about 4%. Just yesterday, right? And that seems to me to be 50 to 100 basis points too high as a permanent location for the funds rate. So I think, like, typically, you know, because of human behavior, the markets overshoot on these inflection points. And I think the markets were pricing in, or have been pricing in, almost 100% probability of this really continuation of really strong growth, relatively high inflation, and a permanence of these really high interest rates. And I think that was overdone. So yeah, I think rates are going to probably continue to fall over the next couple of years, but they'll be choppy, right? Welcome to data dependence.
I mean, the debate is this. Today we've got a slightly hysterical response in the bond market, double-digit drops in terms of yields. That rolls on from the dovish narrative from Powell just the other day. I caught up with the Daimler Truck CEO. He's talking about order intake being strong here, and at the margins, he's maybe got to trim a little bit of fat off his production, but he's not seeing anything like a hard landing or a recession coming down the pike. So this is really perpetuating the sort of softish kind of landing narrative.
Yeah, we call it weakflation, right? Which is not stagflation. It's a kind of watered down version of stagflation, where growth just continues to moderate down toward 2%, maybe even a little bit lower than 2% over the next year or two. But inflation probably does stay above that Fed, target of 2, maybe for years to come. And again, that is not a bad environment, right? That's an environment, man, where the Fed probably ultimately has to cut rates, 100 or even 200 basis points over time. And again, the 200 basis points are not priced in, right? So I think ultimately the whole rate structure comes down a little bit. Growth doesn't, fall off a cliff. I mean, we have a very low probability in our different scenarios of a hard landing. And that's really driven by the bottom up, fundamentals, as you pointed out. I mean, companies, the private sector writ large around the world, and certainly in the US, have been the stars throughout COVID, throughout the inflation regime, throughout the higher rate regime. I mean, they have adapted to these situations, and we're seeing profit margins not only sustain, but actually start to move a little higher. So it's actually been a really good story from a bottom-up credit perspective.
If we sit back as we go to the close of business today, Michael, the market will have heard a couple of things. No rate hike is the optimistic scenario from Powell. 2, the Fed put is alive. If I get something more than an incremental move in unemployment, we will act. And here we are today. Wages are a bit softer. Job growth not just as voluminous as had hoped. I mean, this is a very pro-cyclical risk narrative to close out the week, isn't it?
It is. I mean, it's I know you're throwing the term Goldilocks around a lot this morning, and it really feels like a really good backdrop for investing, whether you're investing in fixed income, which we are kind of pounding the table on really with our clients and generally advising them to add to public fixed income and even to leg into the duration trade as rates kind of back up toward the higher end of the range. And we're putting, kind of 4.5 to 5 as seemingly, near the high end of the longer term range. So, but even for equities and risk assets, you've seen credit spreads in the corporate and high yield market continue even after today hit go back to their new cyclical and year-to-date lows, and heck, maybe they stay at these tight levels for years. And I've lived through a lot of these cycles, Manus, and we've seen periods where credit spreads stay low for years as you're in a relatively benign credit environment, and that's very well where we're heading.
But then, just very briefly, can I square off with that, because the proposition back to you from Adam Posen yesterday, who was with Danny and myself, said, credit spreads where they are suggests that we are not at restrictive enough territory, which maybe plays more to the higher for longer than we're currently pricing today.
Yeah, I mean, financial conditions are easy. I mean, this reset in rates higher will definitely tighten financial conditions if they stay around these levels over time. So that is something that's worrisome. But I think it's not really a financial conditions story. I think, Manus, it's more of just a general moderation in growth over time. I mean, some of these jobs gains, we're seeing basically, as Rick Rieder said, 220, 30, 40,000 jobs a month on average, pretty steadily for a year or two. And it's almost, unbelievable. Like, where are these jobs coming from? Now, a lot of them have been government and healthcare, right? And as you strip those out, the real cyclical part of those job gains have been closer to the run rate of 100,000. So maybe that's just a sign that this economy does have a speed limit, right? And I think we've hit it. So I think moderation and lower growth, but not a hard landing, are in the cards.
Okay, Michael, thank you so much. That is Michael Collins over at PGIM. Coming up, we'll take a look at the health of the consumer. We've got an exclusive interview for you with Jim Risoleo, President and CEO over at Host Hotels and Resorts. The health of the consumer is in focus as earnings season is in full swing. Host Hotels and Resorts boosting its guidance for the year and beating the estimates. Let's have an exclusive conversation now with the CEO. It is Jim Risoleo, the company's president and CEO. Excuse me, Jim, good to see you this morning. So we're trading down at Starbucks, we're trading down at McDonald's. They're not your average kind of client, but talk to me about how resilient, how strong and robust the upper end of the market is in your hotels, because you get some mighty fine ones in the family.
We do have some terrific properties. Thank you for having me today. It's a pleasure to be with you. We released earnings yesterday. We had a very good earnings print. I will tell you that the resilience of the consumer is very strong. We have three business segments: leisure, transient business, business travel, and group. Leisure continues to be strong. We saw leisure rates in the first quarter that were 52% greater than the first quarter of 2019. Business transient travel continues to improve. 5% improvement in business transient travel in the quarter. And the real strength in our business is group. Group is resilient, it's strong, it continues to grow. We picked up 500,000 group room nights in the quarter for 2024. So we're really excited about the way Host is set up for the balance of this year and going into 2025.
Well, look, I mean, that's a very clear trend that everybody's telling me about. But then we're all used to paying a little bit more. We understand there's inflation. We understand it's been tough for you to get the staff over these couple of years. The question is, are you still able to raise prices? Is there a resilience in the face of higher prices across those three segments?
Well, that's a great question. The business transient and group piece of the business are pacing up very nicely. Our total group revenue pace is up 7%. For the balance of the year over the same time last year, and that includes an increase in both room nights and ADR. What we're seeing with the leisure traveler, and we have a unique portfolio of assets. We have 17 terrific properties, and we cater primarily to the very affluent leisure traveler. We are still able to raise rates, but not at the same pace that we have over the last couple of years when we came out of COVID. I'll give you one example. We just reopened last July the Ritz-Carlton Naples Beach Resort that was closed as a result of Hurricane Ian. Our our leisure ADR in the quarter was $1,500. So our leisure ADR at the Four Seasons Orlando in the quarter was $2,000. So clearly, the affluent consumer is still prioritizing experiences over the purchase of goods. And, you know, we have really good product and we provide very good service. So they're willing to pay the rate.
And this is what came through. I caught up with Sebastian Bazin, who runs Accor, some pretty high-end, similar kind of high-end, high-scale businesses to you. He said, Manus, the consumer is changing. They want more in hotel. They want more in resort. So therefore, what are you going to have to add on to the product? What are you doing to develop the product? Is that the next evolution for you, Jim?
Well, it is. And, you know, a good example is our recent acquisition in Nashville. It's a two-property complex. It's a one hotel and an Embassy Suites. New property. We just acquired it last month. And it's located right across the street from the Music City Convention Center. The hotel is differentiated. It has 7 F&B outlets in the property. It has a spa. It has a yoga studio. It has an incredible rooftop bar and lounge that offers unparalleled views of the Music City. In the Ritz in Naples, we added additional cabanas. We added additional F&B outlets. That is what the consumer wants, and if you give them the product, they're certainly prepared to pay.
I'm at the cabana in Naples already. Tell me this: you paid $530 million, $500 million. You used cash. Why did you trade in cash? And would rates have made any difference? Would lower interest rates have encouraged you to borrow money to do this deal?
Well, we're uniquely positioned in the world of lodging REITs. Our balance sheet is a fortress balance sheet. We came into 2024 at 1.9 times leverage. We're the only investment grade balance sheet in lodging sector. We had the liquidity on the balance sheet. We used the cash. And notwithstanding paying $530 million for that acquisition, which we're delighted to get done, by the way, we still have $1.7 billion of liquidity, and our leverage ratio is 2.3 times. So we're well positioned to continue to be an acquisitive company over the course of 2024. Point of fact, we can acquire another $1.1 billion of assets and only take our leverage ratio up to 3 times, which is very much in the investment grade.
And are you in a hungry mood? Are you in a hungry mood to do more deals? Are you going to use the phrase bolt-on? Try and make the last couple of minutes exciting. Tell me you want to do something more than a bolt-on acquisition. Or are you interested overseas? Just give us a little bit of a lift of the hood in terms of what you really want to do.
What I really want to do is put that balance sheet to work and continue to elevate the EBITDA growth profile of the company. It will be domestic. It'll probably be in some of our major urban markets that where we're seeing a strong recovery. It may be an additional resort if we can find one that works for us.
Okay.
So we are really an open book when it comes to where we want to deploy capital. It's where we can get the best returns.
We've just had a jobs report in the United States of America, 175,000 jobs created, less than the market had anticipated. Wages are settling a nib lower. Have you got all the people that you need to hire? Is immigration good for your business? What's the message I walk away with as CEO of one of the biggest REITs? Have you got the staff, and do you welcome the immigration?
We always welcome the immigration, and we have the staff. We're fortunate that our properties are primarily managed by Marriott and Hyatt, 2 top-notch employers that make hospitality a career. So we were able to bring staff back on a lot sooner than a lot of the independent hotel companies.
Okay, Jim, we heard it loud and clear. You're ready to do more. Good to have you with us. I'm always looking for a bargain, so I'll be on the lookout. That is Jim Risoleo, host Hotels and Resorts. We've had a little bit more breaking news. It's a feast of breaking news for you today between jobs. PMI's just crossed. Mike is standing by. What have we got, Mike?
Well, we're doing things backwards today, Manus. The main event was already this morning with the jobs report. But we've got two more numbers out. S&P PMIs for services and composite both come in at 51.3. That is up from 50.9 for both of them in the prior month. So it suggests there's still some strength in the economy, even if not totally reflected in the overall jobs numbers today. 20,000 people added on the retail side. Coming up at the top of the hour, we have ISM services, also late to the party, but we're going to watch that closely because the ISM manufacturing numbers went down on Wednesday. So let's see what happens with services.
Okay, Mike, thank you so much. Some pretty big moves across these asset classes today. Time for your trading diary, what you need to know for the trading week. This is what we got for you. ISM services coming up at the top of the hour, plus Fed speak from Goolsbee and Williams. Mike McKee sits down. Next Tuesday, we get the earnings from Disney. Uber results coming on Wednesday. And finally, the Bank of England and the rate decision next Thursday. Will they come off Table Mountain as Hugh Pill and made it in South Africa last summertime? Quick snapshot for you on risk. This is the equity market reaction function to the lower than estimated jobs report, which maybe questions some of the growth, but what you have is a reaction function to the lower rates. And Apple just barnstorming away with the biggest buyback in American history, $110 billion. And their data on China, less of a dip than the market had anticipated, up 6.83%. I want to reflect back on the impact of this lower than expected jobs report. Jobs growth at 175,000, and you have wages rising by 0.2%. Now, the consequence of that was a real furious move lower in yields. We've given a couple of bips back in some of these markets. At one juncture, we're down by 11 basis points on twos, but there is no doubt about it. The market is moving forward from December to November and now to September, potentially for a rate cut. So the rates market is repricing a little bit earlier than was originally anticipated as we had a hot ECI report. That was countdown to the open for you this week from New York. The Bloomberg team will take you through the rest of this jobs day reporting and the movements on the markets right the way through to the close. From New York, a very good morning from me and the team.